Kochhar is here. Mukul is joining us from Investec. Afternoon, Mukul. In your daily conversations with your clients, well, you are never short of great ideas to tell them. But is their conviction now kind of becoming shaky? Everything seemed to have run up, froth in the market. Will earning growth oblige if they get into new names now? Is that a bit of an issue as well?
Ajay, thanks for having me today. So there are definite signs of fraud, right? And typically at times like these, you need to be cautious in the lower quality, I would say smaller companies, because that's where you will see some malpractice when there's retail excitement, and there can be permanent loss of capital. So when markets are frothy, be very careful where you invest in. So that's one advice, definitely to investors, that is important at this time of the cycle. Having said that, the broader fundamentals in India are exceptionally positive, and this is something we've been talking about for some time now. There are three strong positives for the Indian economy on a fundamental basis. The first positive is we expect India to become current account surplus. And this should happen. This happened in the last quarter, but structurally we should get there in the next couple of years, which will increase, our cross-cycle GDP growth, will make growth more stable and sustainable. The second positive is high profitability in the corporate sector, which will lead to a substantially strong private Capex cycle. With the elections out of the way, I think that trend should start playing out. And the third positive is a premiumizing consumer, a consumer where a lot of the basic needs are already being met, and a premiumizing consumer leading to higher discretionary consumption. That's the third trend, or third fundamental positive in the market today. So there's economy very stable. There's excitement in the market, fraud, where you need to be a little cautious in what you're investing, but definitely, you can get ideas today, as Ajay, you were mentioning in the beginning.
Very interesting point. I mean, that's why I really enjoy our conversation you've raised. One is price run up versus valuations in isolation, but the second is current account surplus plus fiscal deficit under control. And last evening at the 188th Bombay Chamber of Commerce, kind of anniversary, RBI governor made a very important kind of a comment I have not heard for a very long time. He's saying that India is at a cusp of structural shift up in growth. He's making a case of 8% sustainable growth. If we couple moderate inflation and 8% sustainable growth with other points which you said, we could be looking at a kind of a Goldilocks scenario for corporate earnings, is it not?
No, you're absolutely right, Ajay. I mean, and it'll be reflective of the economy. What we are seeing, and the first point you raised, a lot of the stock run up is actually based on earnings. Earnings have been super strong over the last 4 years, 5 years. We have seen earnings triple, or more than triple, actually 3.5 times for BSE 500 companies in the last 5 years, and that's reflecting in the price run up. So that is something one should keep into account when one looks at the market, takes the market in perspective. But to the second point, I actually sort of second that when I say that growth will be structurally higher by 1.5%. And one factor is the current account surplus, which should get us into a more stable economic growth cycle. The second point actually is, I feel that the private Capex cycle, which is going to be very strong, is going to focus a little bit on manufacturing, where as you increase the manufacturing output, the country has been weak on that. That should contribute to the second level GDP growth and creation of some employment.
One point which I want to talk about, which is making me and many others quite uncomfortable right now, is the supply of paper. Earlier tops of the market we have seen with mega offerings on the IPO side. But this time, the consistent supply from PE guys, from promoters, all of that, does it take away a lot of liquidity which otherwise was meant to be coming into the secondary market?
See, more than liquidity, Ajay, the ease with which this supply is getting absorbed points to a certain level of exuberance, right? And which is so. By the way, a great time to invest as any investor would know, is when market sentiment is down in the dumps, when these things are very difficult to get through. And on the other hand, when market sentiment is very positive, you need to step back and see what you're investing in. So yes, that is a definite, sign of concern, the ease with which these, things are happening. But a lot of time, you have to see the promoter selling in the context of them having this source of liquidity, to fund their private sort of lifestyle. So that's not all bad, but the timing and the frequency with which it is happening certainly points to a level of exuberance in the market, which one needs to be cautious about. The IPOs, by the way, just one small point I would want to make to this, Ajay. Cross-cycle IPO quality, and we've been in the market for roughly 2 decades. Cross-cycle IPO quality today is excellent, right? The quality of companies that we see that are coming to IPO is we've not seen this kind of quality companies coming to IPO. So that also should be put in context. But yes, the supply of paper, the level of exuberance is a cause of concern.
Let's talk about some of the areas of the market where you see a lot of cushion because earnings are there, valuations are still not out of whack, and management quality is really very good. Because maybe this is we are in a mature bull run. We may not be in an early stage, and maybe the idea in a mature bull run is to be in safer quality names. Even on pullbacks, the drawdowns will be limited.
Yeah. So Ajay, absolutely. It's not like the entire market is so expensive and, it's not investable. So yes, banks typically are well managed in India. RBI is a good regulator. There, the valuation actually comfort is fairly reasonable. And there, we like auto component stories. We also like pharma. All these are very, very good, high quality stories, high quality sectors available at reasonable valuations today at this point in the cycle.
About some specific areas, what are your thoughts on auto, especially on two-wheelers? You think the story has played out, or you think there is juice because the tier 2, tier 3 rule is coming back?
Yeah. So Ajay, I think two-wheelers have been structurally undervalued in India for many years. If you think about it, and we've been positive on them maybe for the last 6-7 years, as not just now. But let's just talk a little bit about the quality of the business, right? So this is one business where India is globally competitive. It's a very large home market where two-wheeler companies have built economies of scale. They're competitive on quality as well as price. They're major exporters globally, competing with the best in the world. There's very little risk of disruption. While in four-wheelers, there's autonomous driving, a lot of use of technology, connected cars. Two-wheelers, all that trend is, you can imagine autonomous driving. While some people are talking about it, how difficult it will be on a practical purpose. So you can say, if I look 5-10 years out, the current two-wheeler companies globally will probably be the ones leading. So we have a high quality global industry in India. This industry, by the way, negative working capital, very high, return on invested capital, 50% north, very good marketing companies, and historically traded at a multiple which was sub 20. Right now, they've gone slightly higher. But that's also reflective of the second point you made, that they're in a good point in the cycle where there's some replacement demand. In addition, more consumption money in the market means more demand for two-wheelers. So we are very comfortable given the high quality business that they are, despite the run-up that these companies have seen.
Well, you do have beyond the mega caps as well, largish mid caps. In that category, what are your high conviction bets where you see aggressive management growth, capital allocation policies are under check?
Yeah, so Ajay, we are unfortunately barred by compliance to talk single stock. But the three sectors I named for you, and some in utilities as well. The three sectors I name have which is financials, banks, some very high quality banks, regulated banks, small finance banks trading at very, very affordable multiples. Autos, OEMs, two-wheelers we like. Some four-wheelers also, at this point have become attractive in terms of valuation. Auto comps, by the way, very, very sort of good sector placed right now given China plus one. You can see the numbers coming through for auto comp companies, spectacular. and valuations also are palatable. So many names to hunt over there. And finally, the third sector we named pharma. We have a very strong counter consensus call in pharma where the rest of the street and some of the companies also are quite bearish overall, and even specifically on US growth. And we have a very strong counter consensus call around the US business of these companies, which makes us positive. And these three sectors are very broad, all cap heavy. So you can select some mid cap names there as well as large cap names there.
Helpful. Thanks very much for your time, Mukul. And by
If you like this video, then like, share and subscribe to ET Now.